Welcome. It's John Smallwood and Edward Bow, live from Red Bank, New Jersey. Hope everybody's doing well. Ed, how are you? Can you hear me?
I can hear you. Hope everybody. I'm well, thank you. Hope everybody's well out there. In COVID land.
In election world, we have probably one of the most incredible years in the history of like stuff going on. I mean, this is with COVID, with the pandemic, with shutdowns, with election cycles. Talk about volatility, talk about craziness. So what we wanted to do today is clear my voice and really kick in and go through past election cycles and the volatility that has been there. We've been doing a lot of talking to different think tanks, JP Morgan, American funds about how this works, and the commonality is nobody has a playbook for what's about to happen. It's too close to call, there's no what to expect tomorrow or over the next few days. So this is kind of an interesting spot. I mean, Ed, you had a good conversation with somebody last week too about that, right? I mean, there's no direction.
Yeah, no, I mean, I think there's some, from the election perspective, I think people are a little nervous. Like, what year was it that the whole hanging Chad thing with Florida? It took a while to get over that, but I think some of the things that are being said that if this takes maybe a few days to kind of get through, it's not going to be that long. So that I thought that was kind of positive. It wasn't like going to be weeks till we know the election outcome. So.
Yeah, I mean, you're seeing people prepare for it from different perspectives. I've been watching a lot of news, and you're seeing, some of the businesses boarding up in advance of the election for, afraid of potential looting and rioting and picketing. Walmart removed its guns from the front office of all their stores, of the front store. Not that they're not selling them, but they've removed them during the election period. Interesting. I don't, in the history of my life, I don't recall this being this extreme.
Yeah, I saw the boarding up of a lot of those, we'll call it high-end stores and stuff.
Chicago,
Yeah.
the Miracle Mile, Macy's. I mean, Macy's right now is preparing for the Thanksgiving Day parade, right? Normally, right? And now they're boarding up their windows. I mean, that's that tradition of that Thanksgiving Day parade in itself, and the windows, the unveiling of the windows, one of my favorite things to go do.
You mentioned Chicago. I was talking to somebody within the industry that lives out there, and his take on what happened with I guess the riots or the looting that went on the Miracle Mile was that what he's hearing is those businesses aren't coming back anytime soon, and these are big businesses,
big businesses.
Yeah, I mean, and that's the sad part about the whole thing of when these are businesses. There's owners. I'm not talking about the Nike Superstore. I'm talking about some of the other smaller businesses, and people own them, and their business is devastated. Their lives are devastated. So it's sad to see that. And then how do these communities rebuild, whether it's on a smaller scale or Fifth Avenue? I mean, it's just it's kind of tough to think about sometimes, to be honest with you. So.
Yeah, it really is. So a couple things. I have in the handout section of this, I have all the slides that we're going to use today. I also put in two wonderful pieces. One, JP Morgan, we're going to use some of the slides today, but I gave you the entire content of all their information that they put into it. Really well-written piece, lots of great information, definitely worth a read. And then this piece is a eternal piece that American Funds has put out that really is tracking market volatility and all kinds of world events since 1937. It happens to track one of the mutual funds that they have. Not that we're promoting this mutual fund, but we're saying the Investment Company of America has a track record since 1937. But what they've done, and you'll see it as we go into the presentation, is they've overlaid world events in each and every year since 1937. And some of the, when you look at some of the time periods and what was actually going on, you see, history unfortunately does kind of repeat itself. But we'll climb into that. I want to welcome everybody today too, and just say it's great to have everybody on. We appreciate everybody coming on every week. We're constantly looking for feedback, so any feedback that you can give to us, we would greatly appreciate. Also, I continue to get great responses on the book to It's Your Wealth, Keep It. If you don't have a copy and you'd like one, please contact us. We'll get you one. If you have an opportunity, if you haven't left us a review on Amazon, we're getting great reviews, so I appreciate that, and thank you. This is something that we did years ago, Financial Planning, the Big Picture, which was an animated doodle that we did, but what we were talking about is financial pressure, right? And financial pressure comes from all these events in here, parents, inflation, taxes, events that I want to do with my family, kids not launching, black swan events, which is what we're basically in the middle of one of these, the pandemic is a black swan event that's creating lots of pressure on the world. We're, potentially running into more taxes, et cetera, as we move forward. So one of the things that Ed and I have been talking about is that I've been doing this now a little bit over 30 years. Ed's been in financials, the financial industry for greater than that time frame. My father, was my partner for many, many years. And, a couple things, right, that we see over the time frame is that regardless of who's in the White House, things continue. Businesses prosper. Some businesses don't. Most businesses do. You can't predict the outcome usually. All the great information, and the market does exactly the opposite of what you think it's going to do, right? In the sequence of all these events that we're talking about, all this financial pressure, we've seen a lot of these pressures happening this year. People forced out of their jobs, back home, unemployment, at high levels. I mean, the amount of pressure that we have and where we are sitting right now is what gives us probably the most concern as we move forward, is how can countries, how can cities like Chicago, like Manhattan, like LA, really get back to the stride that they were in without some sort of degree of confidence. And confidence is the key here. Now,
if I just say, like, it's funny, you go back to that slide for a second, you got the, it's so funny, we had, we used to talk about this all the time with your dad too, the black swan event, right? When's the last time something like this has happened? It's 100 years. Like
100-year storm, Hurricane Sandy, the 100-year flood, right? The 100-year pandemic. I mean, it's interesting on 100. I was thinking about that.
We had somebody in the office from one of the insurance carriers about a month or so ago, and when we illustrate things to clients, we have to show them worst case scenario, right? Like, we want to be full disclosure, like, hey, if this is the worst thing that happens, this is how this should perform, whatever we're talking about, whether it's annuity, insurance, whatever. And you remember what he said? He used to say, well, if there's a pandemic hits, then maybe this would happen, meaning like, that little, probably one line in the disclosure that says, this thing may kind of really get really bad. Well, he goes, I can't say that anymore. The black swan event happened. Very hard to plan for. You can't. That's why it's called the black swan event. So from a risk perspective, just really hard. It's like, well, we use a risk profiling software, and there's a 5% variance in it, right? That's the 5% variance. You just can't plan for this type of stuff. So I just figured I'd do that.
Yeah, you saw the risk out at the very end of the risk. You know, when you think about risk in a tails, the tails of the risk, it's far out on that risk, and that's where things get really frightening in the financial plan. It's not just the market volatility, it's all the other factors happening at the same time, right? I mean, there's numerous people that I've spoken to over the last 3 to 4 months where, you know, the kids are back home and the jobs that they were supposed to have are not there. Some of them have been delayed. Some of them have been lucky finding new opportunities. The parents, you know, moved them out of the nursing homes back into the houses. I mean, it is the amount of pressure that's happening. People aren't getting bonuses the way they were getting bonuses. I mean, we're starting to see a lot of this pressure play out, and it happens to be the same concept all the time, is that we know the pressure is coming. And pressure is both negative and positive, right? Positive is, you know, you get a market that's fantastic. That's positive pressure. It's rising this potential of your wealth curve up. And everything that we've been trying to do is to talk about the pressure on the curve. And if you think about this from a timeline perspective, right? Measure this with the amount of money that you have. And today is here, and we're going out into the future, which is, you know, could be a 10-year horizon, it could be a 20, it could be a 50, it could be an 80-year horizon. As you move through this, there's sequences that happen that, and you can't predict how that pressure is going to unfold, you know, how taxes will unfold. One of the things I think back about in President Obama's second term, he came out of the gate and he raised the income tax rate, and he put in a national health care at that moment, and the market was up 32 or 37% that year.
32%.
32%. That flies in the face of conventional wisdom. You would never think that that increased tax and that increased expense of the national healthcare system would actually cause the market to go up, right?
Right. The unpredictability of it was, you know, who would have, you know, and markets don't like unpredictability, which we'll talk about here. And that was like, it's the easiest one to go to. We're like, oh my God, look what was happening in that last quarter before 2013. You're like, nobody talked about it. Nobody foresaw it. Nobody, you know, I just, the more and more I've been in this industry, the more and more I realize we could talk about a lot of different things, and it just goes in whatever direction it's going to go, and we can make our hypotheses and our educated guesses, but it's all that.
What you're saying is perfect, because as you were saying it, it was making me recall like many different meetings and conversations and planning strategies that you go to, and ideas and thinking and courses. And it comes down to really one thing, right? Having a plan that has balance, that you have confidence in to ride through terrible time. And that's what it comes down to. Is having a plan that has multiple things going on at the same time.
It's really, you know, diversification is always talked about in the investment world, but you need a diversified financial plan, right? And one of the two things that John and I always talk about is options and flexibility in the plan, right? If my whole plan is geared around market returns, well, then that's the risk that you've got to bear, you know. But if you have a much more robust plan than just market returns, then, you know, and have different avenues to go down, that's the key to this whole concept here. So
that's the key. That's the key. So what I want to do today is I want to talk about the market volatility pre and post elections, and some of the information that is out there that I think is really, really important to understand where it came from, okay? And what impact it has had over that time frame. So one of the things I want to talk about, the first 5 charts are there's more content, more detail on the JP Morgan piece. These are all produced by JP Morgan. This one happens to come out of the Pew Memorial or the Pew Research Center. with JP Morgan reviewing it. And what it's talking about is the percentage of Republicans and Democrats who rate national economic conditions as excellent or good. I had to look at this chart a few times, right? So if I'm Democratic and I'm looking and I'm here in the year 2000, what do I perceive the economic conditions to be? So both Republican and Democratic people were basically looking at this and saying the total or average of this, everybody's, highly optimistic that the economy looks good, right? As we go through this, the tech bubble is coming down, you get down here, here's an interesting thing. One aspect of looking at this is saying the economic conditions are excellent. The other side is looking at this and saying things are poor. And then there's a period of time where everybody believes that it's the same way. And now here we are in 2020, the Republicans are saying, hey, it's pretty good. 46%, believe that the economy's strong. And then 9% down here, and of the Democratic side thinking things are bad.
Yeah, it's pretty, listen, unless we're in I guess in the 2000s, everybody was, market was doing really well. It was right before the tech bubble. So everybody was it was a consensus. And then you could kind of see like 08 and 09, didn't matter whether the Republicans or Democrats were in office. It was a bad time and everybody agreed to that. I think what the chart kind of shows is, okay, then you kind of start falling along party lines during whoever's in office and not, and so.
So what's really interesting is, looking at the average annual rate of return that occurred, and you come off the back of the dot-com bubble, you had something that was referred to as the lost decade, meaning we had two 50% downturns during that time frame. Actually, the S&P did almost nothing, or in this particular time frame, it actually did minus 4.5% annualized return during now the red environment, right? So what's interesting is you look at this and say it's red during this time frame, why everybody believed it was really dire straits. From this point to here, you had a 16% positive return, and then from 17 going forward, which is right about here, right? Everybody all of a sudden, everything was negative, and now, everything's positive, but you had a 13.8. But here's the key, during the last 30 years, you had a 10.7% return. So we have to be careful. The way I view this is, it's the optimism. It's, if I believe that I'm in the pessimist outcome here, and I take a pessimist position and a stance, I'm probably going to get a pessimistic outcome, meaning one that I'm not really happy with, right? If I'm optimal, I'm probably going to get a better outcome. But you have to look at what's my vision. How long is my vision for? Am I building a 2-month plan? Or am I building, the long haul of 30 to 40 years? And most people that we're talking to, regardless of your age, you're building a 20, 30, 40, 50, 60-year plan. So staying optimal, and I think is really important in making your plan. But having defense is always important. Can't play the game without defense, right? Like the Jets need some defense, right? They got ran over yesterday. Couldn't even watch it.
Understatement.
Literally ran over, no defense and no offense, right? So
when the quarterback's giving his wide receiver a piggyback ride down the sideline after he threw like 4 touchdown passes, it's an understatement. I just have to say, but
right. So that's a perfect example of having, no vision of the future, not a good offense, not a good defense, and not taking the steps to get it there, right? So you got to take the playbook from the other team. Their winning mindset is really interesting here. This chart, I think, is really interesting. Now, technically, took me a little bit to get this also. So this is going to look at the
Yeah,
100 days,
we're gonna have to explain this one a little bit, just because there's a lot going on, right? So,
100 days prior to the election, what happens to the markets, the previous 100 days, and what happened in the 100 days after the market. And then it's colored by, in the election year, 1980, 1984, 1988, 1992, 96, et cetera, through all the election cycles, right? And we happen to be right here, right now on this, we're day one out. So we've already experienced what's happened in the last 100 days. I think the market peaked in the middle of September, right? That was the peak,
I think so.
right? And we've been on a declining mode, okay? So we happen to be right at this inflection point, and the gray zone here, 2008, we had this horrific, we're in the middle of the financial crisis in October, right? If I go back 100 days, it's August. Then we get into October and Lehman Brothers, bankruptcy, and we're declining down, and the market continues to sell off over the next 100 days. But we're in the financial crisis, okay? We're now.
That's the turn right there at the 90-day, right? What was it, March 9th or right after March 9th? So, we're starting.
This would put you into like February. This would put you to February, right? If we're going from November, 90 days.
Oh, you're right. You're
November,
right.
December, it puts you into
Election
January.
day. Yeah, you're right.
Push you into January. But
Yep.
what's interesting is you see the majority, right? Not all the time, but even in this 2000 zone, right? Which is leading up to the financial crisis, you did have a downturn in this time frame. Most of these time frames, you do see the markets coming back and recovering, beautifully during that time frame, right? In that next 100 days. If we remember the last election, markets were basically sideways coming into it, which is kind of sort of where we are. And then the markets, the blue line, which is this light blue line here, kind of hard to see, markets moved, and then the markets really moved, after that in that next 100-day move. So, sorry.
Well, I'm sitting here thinking like, all right, what are the two worst lines we had there, right? We got 2008 and the dark blue is 2000, right? Right before the tech bubble, and obviously the financial crisis. And I'm sitting here thinking, well, we just went through a black swan event in March.
We're right in the same spot. We're right in the same spot.
Yeah, like, are we, obviously we had some big events that happened, right around those times. So, could there be a hypothesis made that, hey, we're past the big event, or is there another one? I don't know.
I think we're in the middle of the big event. I think, as long as the pandemic is out here and people don't have the confidence to go back to the cities, we have that pressure still. That's one of the reasons that we took the defensive mode that we did in the portfolios to kind of, stay positioned, but ratchet up your defense, get a better defense so that things continue, sideways, or we go into lockdowns. That's going to create other
ripples.
Other ripples. So, but it's just interesting. I love the data because the data basically says, doesn't really matter in all these elections. Most of the time it's good, but if there's a crisis happening, the crisis is going to override the election, the way I view it, right? And that's what I see here, is the crisis is going to override this. Now, Ed and I put this chart in pretty much every weekly webinar that we've done and for years, but since we started doing this back in March. And this chart is the S&P 500. It's the intra-year declines versus the calendar year return, okay? What's different about this chart is they highlight the election cycle, in which way, red or blue, that the election goes, okay? But I think what's really important here is in 1980, which I guess was the year Reagan was elected, right? The market was down 17% at one point in the year, but finished up 26%, okay? Take that to the 2000 election, the market was down 8% at some point, ended up 20% in 2000.
No, it's 96.
What was that?
That was
96. Sorry, thank you. I got to get
Yeah.
I'm looking at two screens. So what you see is in that 1995, 96 election, you're up 20%, you're down 8. But the key is, in order to get the up return, you have to get the down return. You have to be down. There's not a single year on this chart where the market is not down some significant number during the course of the year to get to this 13.8% average rate of return.
Look at 1998 is pretty glaring. You've had to weather almost a down 20%, to get the positive 20%, 27%,
I think that was
how many people get nervous down 20%, right?
Yeah, that was the Asian contagion, right? July to July. Yeah.
I believe you're right.
So what's interesting is positive, despite average intra-year drops of 13.8%, annual returns positive for 30 of the 40 years. And if you look at this on a time chart, you've had a positive return over the entire time frame, despite the downturn. But I think what's interesting is when you look at the chart, you don't really have a correlation of red or blue versus the market. I mean, here you have a red where the market's down, but that's the 2001-2 crisis. And then you've got a blue election where the market's down, but then the market's up, and it's up dramatically. So, the history says, no big deal. Doesn't matter.
Market's going to do what it's going to do.
Market's going to do what it's going to do. The fuel of this is going to be the economic incentives that we need to put out. I mean, it's clear that in certain industries, certain regions of the country, we really need to put more infusion of capital into the right areas, to hit the right areas. And it's clear the places that the money went back in March and April really dramatically impacted the markets in a positive way, because the market, middle of March was down about 34%. When this chart was done, which was like 2 weeks ago, October 5th, okay, market was up 6% still. We're now into a flat environment, but not bad for an election period. But that infusion going to the right places, and some would argue that it didn't go to the right places, and I would look at that and say you're correct, because a lot of places it went to, it was abused. And there's still, Larry Kudlow over the weekend mentioned that there's still $135 billion of unused PPP money that you can't apply for, but it's unused. And they were looking to redirect and redeploy some of that. But it's clear that that money needs to go to some of those businesses that are still operating at 0% capacity or 25% capacity. The airline industry, Ryanair this morning was out talking about, he's off 80%. That's flying all over Europe. We have some crisis here, but we need to get that money back. And as you get that government infusion, I think you're going to see the markets come back nicely. The markets have come back nicely. So, but some of the areas haven't, like the value stocks, the bank stocks, things are still down. There's still tremendous opportunities. There'll be opportunities in real estate, even, in the areas where the problems are, in the areas where the bubbles are happening in real estate. I think, a little defense is going to make sense there. But it's interesting to see this, that every single year you have to have a negative experience to get a positive. 30 of the 40 of them. All right. Absolutely. Anything else on this?
No.
So this is the last JP Morgan chart. And basically it's the S&P 500, growth of $10,000, annual returns since 1937 through 2019. It's highlighted in blue versus red. So during a Democratic president, during a Republican president, and what you see, or what I see, is I see there are periods where the markets are off, like 1942 or 3, and then, the markets come back up and then they're off and then they're back off and then they're on and then they're off and then they're on. But the trend of this is that $10,000 invested without taxes, which is another pressure, without fees, et cetera, right, is over $10 million of outcome, okay, that invested over that time frame, despite all the downturns and all the negative stuff. So I read this chart, my position is red, blue, be a long-term investor, stay true to your course, have enough cash, have enough reserves, take enough money off the table to live your life the way you want to and protect it. But there's some tremendous opportunities that hopefully we'll take advantage of as we go forward here. Ed, you want to add anything here?
Yeah, absolutely. Have gotten a few questions coming into the election and whether people are positive or negative about it, what they should do. And I've gotten asked these questions at some financial literacy events that I've done in the past. And, you got to look at your plan. It's what, whether it's overall plan or your investment plan. If we're strictly talking about investment, just is this long-term money? If it's long-term money, you got to try and stay invested. That's what the chart you're looking at right now. It doesn't matter about which party's in there or not. And so it gets very emotional. It gets really hard sometimes to do that. I had a client say to me that, they're in their 401k, they're going to cash. I'm like, what did I think? And I said, if you really are passionate about you can't handle the, whatever outcome you think is going to happen, and you want to go to cash, I would at least do some, not all of it. That way, you're either making a really good decision or a really bad decision. There's no in between when you do that. If you go all cash, right?
And that's a short-term strategy and a long-term planning vehicle, right?
And John will tell you, have a lot of Wall Street experience, a lot of trading experience, and timing is very, very hard to do. And again, you're either really right or really wrong. I mean, some of my best buddies who were traders, I could tell you you always hear about the winners, you never hear about the losers when they start talking about their track record. And they've had losers, and it ends up balancing itself out of what you've actually made, because you're not going to, from a timing perspective, you're going to win some bets and you're going to lose some bets. That's what it is. So, so I usually say, if you have to do something, you got to leave some in, and that way, hey, if you're wrong and the market responds well, you can leg back in if you want, but you didn't take all your ammunition and move it off to the side and just.
But if you have a balanced plan, meaning you have the right amount of cash, you have the right amount of reserves, the right amount of cash values, the right amount of protection in place, and then you have the right asset allocation, you should never be going to cash.
And I agree. That's why I started off saying, it's okay, what's the money meant for? Is this a long-term plan? Is it a long-term strategy? You probably really shouldn't be doing it, but
How many people went to cash in the last election? The market was extremely, go back a couple of charts. There was a lot of volatility coming into that, up and down days, right? Go back to this chart, right? Not this one, this one. The light blue line, you really can't see it, but there was a lot of volatility up and down in here, up and down and up and down. And then, if you were out, most of that return of what is affectionately called the Trump bump happened within 60 days of the market, and it happened quick.
And what's funny about that? Again, we kind of talked about it earlier in the webinar, and people, we hear this different information coming at us from all sorts of different venues. And if you listen to what was going on then, actually, they said if Trump actually got elected, he even might have even said it. He goes, I think we'll have a recession. So it may not be good for the economy, which tends not to be good for the market. If Hillary Clinton had been elected, which everybody thought that was what was going to happen, and they thought that was going to be a positive thing for the market. And so you're hearing all this rhetoric, right? You all up into that. And I'm not taking one side or the other. I'm just saying you're getting all this information thrown at you, and it's all wrong. And it was wrong. You had the Trump bump anyway. It's like, so if you're preparing for the worst, let's say if he the recession, and now you're that's my point. It's really hard to delineate this information and how it's actually going to come out. So
You have to be prepared for both outcomes.
exactly.
That's what we've been saying. That's what every single time that we do this, every time we talk to a client, if I have that strategic balance in the plan, I'm prepared for the outcome that's going to happen, whether it goes down or not, because it's part of the overall plan. I mean, market volatility, go back 2 charts, 40 years of charts, pretty clear. You got volatility every single year. As we get into these next charts that are produced by American funds, you get a little different skew on this. And I think what's really interesting is one of the things that's in the piece, I copied this out, that's in the handouts, is there, since 1937, when they started tracking all this information for this particular fund, there's been events every single year that, weather-related calamities, businesses going bankrupt, market declines, overseas conflicts, civil and political unrest, labor market struggles. I mean, this stuff has been going on for a long time. And I don't ever see this going away either.
By the way, the other problem with coming out of the market, right? And this is what we saw like in 2008, 2009. Again, that was huge black swan event. There's 2 decisions. There's one coming out and one going back in. And it's really, really hard to try and get both of them right. It's really hard. That's why we're saying what we're saying here. Okay. People that, let's say, did go to cash at, we'll call it end of 2008, 2009, it took years for them to get back into the markets. It wasn't
you went
like,
to cash, yeah, and then you got back at the wrong time.
I mean, yeah, right. And that's why it is very hard. That's why you need balance. That's why you need, I think I was talking about earlier, if your only solution is market volatility, then you've got to bear that risk. And that's really hard that is really hard to handle at these very, these black swan events. It's difficult. It's really difficult.
One of the books that I read years ago, talking about risk, and I believe it was the Ed Easterling book, talking about markets and long-term markets. I forget the title. I remember the name of the author. JP, text me if you're on. But the quote from the book was, risk is not like fertilizer. If I sprinkle fertilizer on my, my shrubs and my plants, the right amount of fertilizer, it's going to grow. But risk, market risk is not like that. Just because I take risk doesn't mean I'm going to get the return, right? And that's one of the things that people make the big mistake in the planning process, is to take excessive amount of risk without really understanding what the consequences of that risk is. It's because typically, if I don't have to touch the money, in the long run, it's going to be okay. The problem is when you start going back to the original chart, if I click back over here, back to this chart, right? It's the sequence. We're in the middle of a black swan event, and kids are going to college, and kids have lost their jobs, and your parents come home, and, oh, I'm not making the same amount of money I was making last year. That's something you can't predict that's going to happen, right? So it's that risk. We tend to look at things in that narrow focus, is I can handle the risk on this other side, assuming all the other variables stay the same.
I was ready. See that kid sitting in the chair there? I was ready to launch one of my first ones out. And I say, as my favorite saying is, get him off my payroll, right? Get him on somebody else's payroll. And this black
On
swan
their
event.
own. Get them on
So
their own.
my curve has changed a little bit because, you know, I've got one still hanging around.
Yeah. So I thought this was really great, and there's a lot more content in what I gave you. It's a fabulous chart that takes every year since 1937. But what they wanted to do here was highlight each year, blue is the Democratic side, R is the Republican, and what were they facing? So in 1936, Franklin Delano Roosevelt versus Alf Landon. That's a name that I would not have ever been able to recall. US remains in grip of the Depression, and the Nazi rise troubles Europe, right? So everything's heating up. He gets elected again in 1940. Another guy that we don't know anything about, Wendell Willkie, he loses. Isolationism versus engagement, hotly debated. Germany menaces Europe, and France are falling. So the world is really ugly here, right? And there he is again, 1944, and FDR's health is in question, post-war impact, New Deal debated. And then as you go through these things, you look at, JFK in 1960, versus Nixon. You get to Cuba nationalizes US assets, right? I mean, Ed, you can really talk about this being 100% Cuban, what this means, right?
Yeah, you had a business down there. It's no longer your business. That's it.
Yeah. And all the US assets are now nationalized. They became part of Cuba, right? So talk about the pressure to deal with that. And American
A
U-2
little
spy
bit to
plane
the
jumped
point
down.
it became the dictators, not Cubas. You know.
Yeah, so you got the Soviet influence, you got the height, the Cold War growing. I mean, the amount of pressure that's going on in these different timeframes is tremendous. The amount of obstacles that everybody faces in these different election periods. Looking at, I was joking about this, and hopefully I'm joking about this, right? 1976, Jimmy Carter versus Ford. New York City was threatening bankruptcy, and the economy's mired in recession. I mean, if you read that today, you would believe that that's today.
Right, we're technically in a recession right now, right?
Right. And New York City, MTA, and all these places are having some significant issues, right? 1992, Clinton, the LA riots, NAFTA, these terrible things happening, all over the place, right? Tech
Bubbles.
bubble burst in 2000, markets plummet.
And yeah, like you were saying earlier, it's like somebody was just saying to us, like, this time is different. It seems so much longer. And I'm like, well, what's longer? Let's get that perspective first, right? Is it 3 months or 3 years? And I'm like, there's been stuff like this going on for a long time. It just, I think it's more amplified because we get so much information now thrown at us from different avenues versus we'll call it 1980 or 1970, So
The amount of information, the access to information, the inability to, I don't care what side of the fence that you sit on, the amount of information that's coming out, and let's just say, is it really right what we're listening to? And I think it creates people, looking at things in stilted ways, because I don't think any of the information that's being presented is really, really accurate. I really don't. I think we have a lot of misinformation going on, and that's, I did a piece on this a few years ago where we were talking about, the publications that are in the media and what's happening about financial conditions, and like, if you were in 2008 in the crisis, the bottom of the crisis after Lehman Brothers collapsed and the markets fell, and it's March of 2009, and you're watching, Glenn Beck, and he's talking about the economy and the debt, national debt is like a hockey stick, and then we're in this hockey stick, and the world's going to go to hell in a handbasket, and the world is over. It's good information, sold a lot of media, right? But was it correct? No. All right, because there's other events that we don't know are going to happen. There's other sequences here. So the key is, right, as we go through this, so what they did here is they took their fund. This is the Capital Group, which is also American Funds, and it's a 10-year period, begins in January 1st of the year shown and ends on December 31st of the final year shown. For example, the first period listed is 1936 to 1945, covers all of 36 and all of 45, okay? So in 1936, if you invested $10,000 in this fund, you know, by 1945, it was worth $25,000. The initial $10,000 investment, right, which is right here, you know.
And it's color coded to the party at the time, right?
ICA total ending value 10 years after the start of a Democratic presidency, 10 years after the start of a Republican presidency.
Right.
So in every 10-year period after a blue or a red, during this time frame, the worst one is the 2000 to 2009. 10,000 only turned into 12,000. Every other one is significant. The best one is what? 49,000, which is 1980 to 1989. Which at that point, New York City was threatening bankruptcy, right? The 10-year treasury was 15.81%.
And you had 1987 in there, right?
87 is there. The 87 correction is there. You know, the
Yep.
S&L crisis. The S&L crisis in there. There's a major tax law that basically, you know, takes away all the accelerated depreciation and all the tax write-offs in the 1986 tax law. It also dropped the tax bracket from, I think it was 50% down to 28%, but all the deductions were taken away, right? So we're in the same, you know, here's the problem. All the tactics are the same. Everything's changing. The rules are changing. The rules are going to change, you know, in 10 days when we know, or 20 days, or 5 days, or 2 days when we know who's president. Well, you know, who has the House, who has the Senate, where are we? That's going to create change, right? And change is going to, you got to rethink your strategies. You got to rethink, am I doing this properly? Am I putting money in the right places? Am I getting the highest amount of efficiency with the dollar that I'm spending? Am I getting the least amount of risk? Am I paying the least amount of taxes today and tomorrow? Am I paying the least amount of fees today and tomorrow? Am I going to have the max amount of income in retirement? Am I going to pass the maximum amount to my family? Am I going to have the best protection for all this stuff that's going to potentially happen back on this wonderful timeline, right? So today we thought focusing on the presidential election and the outcomes thereafter, every single one of these outcomes since 1936, 10 years later, I like the outcome, right? You know, this chart, you know, blue, red, it's good, right? It's the short periods where we need to be aware of what's happening. You know, as we close this and wrap up today, some of the things that I just want to say, if you're having concerns, if you're uneasy about what's happening, and we want to talk about, you know, updating the wealth curve blueprint. The blueprint is a really great way to get very clear on where is the income coming from, how is it being taxed, where am I saving, what are my expenses, what are my debt, my principal, mortgage interest, what are my real estate taxes, what are all the insurance costs, what's the lifestyle number, and then where are the assets and how is it defended? Do I have enough life insurance, disability, long-term care, are my wills and trusts appropriate? You know, if the estate planning rules could dramatically change in the next 30, you know, not next 30 days, but into next year, depending upon whether it's blue or red. I believe all tax laws are going to change because of the other pressures that are out there. Social Security Administration's got problems. A lot of the big pensions in the country, both government pensions, state-run pensions, you know, state government pensions, and also a lot of the corporate pensions have significant issues. We have $6 trillion of stimulus that needs to be paid for. Taxes. That's really one of the great ways to pay for it, is to raise taxes and reduce benefits. So a lot of pressure's coming, and we're here to help. That's what our job is. So, Ed, closing argument.
No,
Okay.
we've been talking about, I think we've said it in prior webinars and been talking a lot with the clients about this is, again, what doesn't matter whether you're right, left, or in the middle, it doesn't matter. Checks are being written, this quantitative easing, it's gotta, the rubber's gotta meet the road at some point down. So that's why I agree with, taxes will have to go up at some point because you just can't keep kicking this can down the road. When,
Or benefits
yeah,
reduced, combination of that.
yeah, does it happen sooner or later? I don't know. It just, this stuff has to be paid for at some point,
Can we grow ourselves out of this? If we can grow ourselves out of this by increasing sales, is really what it comes down to. All sales across the United States, right? Can we
Right.
bring revenues up? Can we, protect our national interests? Can we protect our intellectual capital? Can we make sure that our stuff, our clothes are, manufactured and created by people that we love and that are being, treated properly? All these wonderful things, right? That's, if we can grow ourselves out of this, we can maintain low taxes and maintain high benefits. But unfortunately, I don't know if we can do that. We can probably have to have a combination of, growing, benefit reduction, potentially tax increase to get ourselves, on the right track as we move forward. But growth is really the key. So the entrepreneurs need to get out and create, right?
Yeah, absolutely. I probably should say the tax bill will have to be paid, at some point. How it gets done, we still have yet to be seen, right? Whether it's, as you said, kind of grow our way out of it or taxes go up, I'm not sure. That's probably the uncertainty, and that's what, and markets really show indications of uncertainty. When things are uncertain, the market kind of reacts to that, right? When things are kind of more certain, you get more predictability out of the market. So just keep that in the back of your minds. That's kind of how it goes up and down. It's always been a 6 month kind of a predictor in a lot of ways. I think it's been a little harder to see that, but it is, it's kind of looking down the road for us, so that's about it. Obviously from everything that we've shown everybody today, that it doesn't matter if it's Democrat, Republican, or whatever. There's good and bad periods for each one of them. There's no trend to it. So
Yeah. Well, this was, I thought, a good conversation. I appreciate everybody being on today. We will come back with a webinar 2 weeks out. We're trying to tweak the content a little bit so that we get into more of the planning process. Depending on the election, we will have a lot to say about next steps in the planning process, and I think it'll be really an important part of how we're going to do this, because depending on what happens, there might be a lot of estate planning work that needs to get done, etc. But either way, good planning needs to continue. So we're here for you. We appreciate you being here. Any questions, concerns, please call us, email us, carrier pigeon, whatever is more convenient.
just one more point. If you get a chance, read the JP Morgan handout. It's actually a really good piece. It has the text in it really explains a lot, and I think they walk you through this very well. So if you have time, look.
It's really well written. It's
It
great.
is.
And the American Funds is just great information in it also. So
Yep.
Enjoy, share it. We're going to post this as a podcast later today. So if you want to share this, this would be a great piece to share with friends and family, enemies, people that are blue, people that are red. I'm just kidding. But this information, I think, needs to be in the hands of a lot of people. So thank you. Ned, any final?
That's it.
Right. We're signing off.
Everybody be well.
Be well. Thank you. Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative.
The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.